Good morning, everybody, and welcome to WHEB's Q3 webinar. Claire Jervis, Associate Portfolio Manager, will be going through a review of the strategy and the outlook this morning, just covering Q3. We will be, just to trail it, and I'll mention it again at the end, but we will be doing a longer-term view of strategy, performance, and outlook at our annual investor conference, which is at the end of November. So please look out for the registration for that on our website on the 28th of November. And then once Claire's gone through the strategy review and the outlook for Q3, then Rachael Monteiro is going to join us, and she is going to talk about a summary of our new Stewardship White Paper, which is due to be published next week, and she's going to review some of the key findings from that white paper, that forthcoming document coming out next week. So that is all from me, and at that point I'll just hand over to Claire. Thank you.
Thanks, George. So we're going to start out by looking at some of the main events that happened in the quarter. Then we're going to talk about performance and how our strategy actually fared during the most recent quarter. And finally, we're going to look at what's coming around the corner with the outlook. So starting at looking, what were the main events in the quarter? The first was obviously another disastrous hurricane season striking North America, with Hurricanes Helen and Milton both causing massive amounts of economic damage. And of course, when we talk about the rising impact of hurricanes, we often look at economic damage, how much the financial cost was. And one critique that's often levied against that analysis is that it doesn't adjust for things like inflation, population changes, and things like that. But one piece of data that we can look at, which is pretty much irrefutable, is the change in average wind speed of hurricanes over time. And you can see from the chart on the left-hand side how there's a very clear upward line in hurricanes getting faster and faster over time. And this has a very clear correlation with economic damage and also loss of life. Some researchers at Imperial College London have done some research already on the hurricanes Helen and Milton, and they found that the impact of global warming meant that those two hurricanes hit land 10% faster than they otherwise might have done, and resulted in them hitting land at a Category 3 hurricane rather than Category 2. And so really, this is a very clear cause from global warming and climate change, and it has a very real financial and human cost, as we have seen over the quarter. Another big piece of news during the quarter has been various Western car makers sharing their woes and struggles, basically, and coming out sharing information that they're going to be cutting their guidance for the year. We've had BMW, Mercedes-Benz, Volkswagen, and Stellantis, all of which have posted disappointing results and slashed their guidance for the year. And one thing they all have in common is that they have all attributed this to weakness in China, specifically economic weakness. But it is possible that there's something else going on there as well, because China is a really strong market for electric vehicles, and electric vehicle sales have still been pretty good. But you can see on the right-hand side how German car makers, and probably American ones as well, have been gradually losing share in this Chinese electric vehicle market, as domestic companies like Geely and BYD have been taking the lion's share of growth in the electric vehicle market in China. And so, although this has been disappointing for the Western companies, it is possible that it's not just Chinese economic weakness, and is actually a sign of something more serious underlying that, which is that these car makers are potentially losing share in China. Another key headline, which has maybe flown a bit under the radar, is the anti-corruption campaign impacting the Chinese healthcare industry. So China has been implementing an anti-corruption campaign for some time, looking at various industries, trying to stamp out fraudulent practices. And this year in particular, they've turned their sights to the healthcare industry. And it's clear to see why. You can see on the left-hand side how Chinese healthcare costs have been surging since the 1990s. And there is pretty strong evidence to suggest that part of this increase in cost is down to fraudulent behaviours in the Chinese healthcare industry. And this has actually impacted our portfolio because although we don't invest directly in Chinese businesses, we do have a number of global healthcare businesses that sell their products and services to China. And what's happened is that the healthcare providers, the people who are making decisions on what equipment to buy, have pretty much hit the pause button because they're scared of this anti-corruption campaign and they want to, wait to see how the dust settles, what the regulations might look like, things like that, so that they can, go back to their normal behavior without having to worry about being in the sights of the Chinese government. And so that has been a headwind to the entire healthcare sector, and it has impacted some of our portfolio holdings as well. But more positively, we have had a piece of good news this quarter, which is that some people are saying that we are past peak obesity, because for the first time in about 40 years, the obesity rate for American adults over 20 years old has declined year on year. And some people are attributing this partly to the rising positive impact of novel obesity therapies like GLP-1s, such as Wegovy and Mounjaro. And although we can't directly claim that those drugs have caused this decline in obesity, it is clear from the clinical trial data that there has been a significant positive impact for the patients that have taken this medicine. You can see on the right-hand side the clinical data for Wegovy, which is Novo Nordisk's obesity drug. It has resulted in a loss of weight of about 15% for the patients that took it, compared to about 3% for patients taking a placebo. And that is alongside dietary changes and also lifestyle support from the doctors as well. So this is a very clear positive impact from these GLP-1 medicines. So turning to the strategy and how that's performed over the quarter, to be honest, it's been a fairly uninteresting quarter in that both our strategy and the index have just hugged either side of flat over the quarter. And this is how our performance looks over a long-term time period. And this is how our performance looks broken down by the different themes in our fund. And you can see that the most significant detractors from returns, unsurprisingly, are the healthcare sector and the sustainable transport theme, which both link back to those trends that I was speaking to you about before. We did, though, have some more positive information from some various companies in the resource efficiency and environmental services themes, which helped to support performance during the quarter. And these are some of our best and worst performers on the stock level. And we're going to spend some time now just focusing on what was behind each of those different companies and why it did quite well or not so well during the quarter. So if we start by looking at Icon, Icon is in the healthcare theme. It is a global clinical research outsource organization, so a CRO. And basically what they're doing is they're performing clinical research on behalf of pharmaceutical companies of all shapes and sizes all over the world. And of course, they will see some of that China disruption, as well as some issues with biopharma funding being somewhat slow at the moment. It's important to mention that Icon has been a pretty strong performer for us recently, and so this quarter has really been more of it taking a breather. And the reason for that is because we had some disappointing revenue growth out of the US and rest of the world business. Europe has been pretty good still, but outside of Europe, it's been a bit disappointing. But we're not too worried about it because when we look at the company's order backlog, we see very strong momentum and even acceleration in their order intake. And in fact, their book-to-bill ratio, which is the ratio between how much they book in revenues versus how much they take in new orders, has been consistently above 1. And that indicates that, that they're taking more orders than they're booking in revenue. So in future, we are going to see revenue growth as that backlog converts. So we think that we're still really positive on Icon, and this is really just the company taking a breather after quite a strong few months. Our second most significant detractor was Novo Nordisk. So this is a company which is very well known for manufacturing Wegovy, that obesity drug that I was talking about earlier. And Wegovy has really been phenomenal for Novo Nordisk's revenue growth. You can see on the left-hand side, Wegovy is that kind of light green bar, and the blue line is Novo's total company sales. And you can see how since the end of 2022, Wegovy has really been pushing that line upwards. So this has been a really strong growth product for the business. And essentially, they just can't make enough of it. They can't make enough Wegovy vials, essentially, to service their demand. And so what's happened is they've had to stop issuing starting doses for new patients, because the way it works is that new patients are put onto this starting dose, and then gradually over time, they're kind of levered upwards onto a larger dose, which helps them to cope with the side effects from the medication. And because Novo Nordisk can't make enough of the medication to service their total demand, they are very sensibly prioritizing the patients that are already taking the medicine. And so they're not issuing new starting doses. They're not bringing in new patients. And obviously that's going to have some impact on their revenue growth. But still, their growth is phenomenal. And we are very confident that they're bringing on new capacity. And really, it's quite a nice problem to have when your demand is so great that you just can't make enough. So we're not really worried about it over the longer term. It's just been a bit of a short-term issue as the company ramps new capacity. And finally, on the negative side, I mentioned sustainable transport was a headwind for us, and that's been mostly linked to these Western car makers. And in our portfolio, where we see that is in our semiconductor holdings, because we don't invest directly in car makers, but we do invest in a number of semiconductor businesses which serve the automotive market. And Infineon has been the biggest attractor because Infineon has the biggest position in automotive semiconductors. You can see on the left-hand side how they are by far the #1 global company in automotive semiconductors, and they have particular leadership in power semiconductors for automotive. So these are the semiconductors that actually drive the engine of an electric vehicle. So they have been impacted by this disappointment from Western car makers. But one thing that we like about Infineon is, as you can see on the right-hand side, their geographic exposure is actually quite well balanced. They aren't just exposed to Western car makers. They do have a Chinese automotive business as well as a business in Asia-Pac, including Japan. And in fact, the Chinese revenue growth is expected to be quite good. So they're expecting China to be an even bigger part of their business over time. And so even though Infineon has been impacted by Western car makers, being a bit disappointing, they do still have access to this phenomenal growth coming from the Chinese electric vehicle market. And moving on to a couple of more positive stories during the quarter, we had really strong performance from Trane, which is an American HVAC business, which stands for heating, ventilation, and air conditioning. And Trane has actually been a really strong performer for quite a few months. You can see on the left-hand side, their year-on-year revenue growth, which is that bright blue line, has been consistently in the double digits for several quarters. And so, it's been quite a good performer. But what's been a surprise this quarter in particular is their residential business, because previously that revenue growth has mostly been driven by strength in their commercial business, because their commercial customers are buying these energy efficient HVAC machines. They are trying to meet their net zero targets. And that's a really positive story for Trane, because they have a real leadership in energy efficient HVAC equipment. But residential HVAC has been a bit slow recently, and that's because we are seeing a gradual transition away from environmentally damaging refrigerants. And this has been going on for quite a long time. You can see on the right-hand side how we judge the environmental impact of refrigerants by looking at two main factors: their global warming potential, which is on the y-axis, and their ozone depletion potential, which is on the x-axis. And way back in the 1980s, we were using a type of refrigerant called CFCs, which you can see is pretty much to the far right-hand side of that chart. So it's extremely environmentally damaging. And over time, we've been issuing new protocols, new regulations to gradually transition to refrigerants that are less environmentally damaging than the previous generation. And now we are currently in the process of transitioning to a type of refrigerant called an HFO. And you can see in the bottom left of that chart that these are much, much better for the environment. The global warming potential and ozone depletion potential of HFOs is close to zero. And so that's actually a really good thing from an impact point of view. But one thing that has been bad for companies like Trane is that this transition has caused some uncertainty. People aren't sure when the regulations are going to come in. They don't want to buy new HVAC equipment if there's a risk that their refrigerant is going to be outlawed very, very shortly after. And so that's been kind of a drag on new sales for the residential HVAC sector. But we are now getting clarity on that, which has been good because that has given people the reassurance that they need to start placing new orders for residential HVAC equipment. And finally, another company which has been really positive during the quarter has been Bureau Veritas. So this is a testing, inspection and certification business. And historically, it has been a pretty, steady, high quality business, steady mid-single digit revenue growth, quite high returns, quite a nice little business. But recently, they've seen an acceleration in their revenue growth because they have established a part of their business called Green Line Services. And these are services specifically targeting businesses who have a need for ESG services, green energy services, things like audits of their supply chain for ESG criteria, checking that their emissions is being reported accurately, giving them advice on how they can decarbonize their business. All these kind of things, which is really important for a number of corporations now. And also they test and inspect actual green energy plants, so wind farms, solar farms, things like that. And this has been a really positive growth story for them, particularly because their corporate customers have all these ESG criteria and goals that they're trying to meet. And so we can see how their Green Line services has really helped their revenue growth. At the moment, their Green Line services make up just over 50% of their revenue. So it's about 3 billion euros in annual revenue. But you can see on the right-hand side how the market growth between now and 2028 is really expected to be quite phenomenal. And of course, Bureau Veritas won't access all of that growth, but it will be a very strong boost for them, particularly as they've positioned themselves so well in that market. So turning to the outlook then, we talked a bit about Novo Nordisk this quarter and how it's been a bit disappointing because they haven't been able to make enough of this therapy. And I think when we talk about obesity, the media in particular, and in fact, many investors are very focused on GLP-1s, so things like Wegovy and Mounjaro. But I think one thing that is often missed is that GLP-1s are really just the beginning of this story, and that there are tens, if not hundreds, of new obesity medicines in clinical trial pipelines at the moment. And these aren't just GLP-1s. There are a number of different active ingredients which are being tested for their obesity that benefits to patients. And you can see on the right-hand side the various different active ingredients in clinical trials at the moment. The purple is GLP-1s, but there's all sorts of other different active ingredients being trialed. One that Novo Nordisk actually released data on this quarter was CBD cannabinoid, which actually comes from the marijuana plant. And their clinical trial data, it was phase 1, so it's quite early. It showed good benefits to obesity patients, but it did have some unintended psychiatric side effects, which they're having to work through, but they're still pushing it through phase 2 trials to try and deal with those side effects. And one active ingredient we're really excited about is something called long-acting amylins. So long-acting amylins is a type of therapy which is being trialed by Novo Nordisk and AstraZeneca for obesity patients. It is kind of like a smaller, less strong dose of a GLP-1 in that it's targeting much kind of more slow and steady weight loss. And the reason long-acting amylins are really interesting is that by targeting weight loss in this way, they can help to reduce fat mass whilst preserving muscle mass, which is really important because loss of muscle mass has been associated with a shorter lifespan. And at the moment, these GLP-1s that are on the market today don't distinguish between fat and muscle. And so if you're losing weight, you're losing both fat and muscle in many cases. So there's a really big pipeline of therapies, and the reason we're investing in Novo Nordisk isn't just for Wegovy, it's for this whole pipeline that is going to be, we think, a really strong contributor to their revenue growth for years to come. And finally, of course, we can't let you go without talking about the US election, which is just around the corner. And of course, the thing we're most focused on is what a potential Trump presidency could mean for climate funding, particularly in light of the Inflation Reduction Act, which came in through Biden's presidency and promises, hundreds of billions of dollars of funding for climate projects. And really, it's we think quite nuanced. I've included on the right-hand side an extract from Trump's Agenda 47, which is essentially his manifesto. And I've highlighted a number of different provisions which are related to the climate energy transition. Firstly, you can see that he's looking to make America the dominant energy producer in the world by far. And really, he's not going to be able to achieve that without investing in solar energy, because it is the cheapest form of energy you can buy. And he's also looking to stop outsourcing and turn the United States into a manufacturing superpower, which, of course, is very beneficial to the various incentives that have been brought in through the Inflation Reduction Act, which seek to incentivize domestic manufacturing. So for the most part, we think that those provisions of the IRA around cleaner energy and domestic manufacturing should be fairly safe under a Trump presidency. The one thing which is more of a concern, though, is the electric vehicle market, because they don't just have China to worry about, they also have Trump to worry about in their home turf, because he has made it very clear that he doesn't believe in the electric vehicle transition, and he wants to cut any subsidies that have been promised as part of the Inflation Reduction Act. So that is something that is probably going to be more negative if Trump does come into power. But I think the one thing that often gets missed when we talk about elections and policy is that really it's not policy that drives the energy transition, it is market forces. Both parties in America have presided over a boom in oil production. Both the Trump-Pence administration and the Biden-Harris administration have both, sadly, overseen massive increases in oil production in North America. And yet, clean energy has dominated their new utility scale capacity additions. And so even though they're producing more oil, they're still investing in particularly solar energy because it is the cheapest form of energy you can buy. So that is really something that I think often gets missed when we talk about Trump in particular. But also I wanted to leave you by looking at some charts from Bloomberg New Energy Finance. So they have actually come up with two different scenarios for the energy transition. One is the net zero scenario, which basically assumes that we, have all the policies and all the things in place to meet our net zero by 2050 commitments under the Paris Agreement. And that is these kind of dotted lines on these charts here. But the other scenario they've come up with is called the economic transition scenario. And that looks at what adoption of various clean energy technologies could look like based solely on market forces, so without any change in policy. And you can see from these charts that in all cases, they are expecting pretty strong growth, even without policy. Just based on economic market forces, they expect strong growth in a number of different energy technologies. And so as investors, that's a really strong positive for us, because it means that we don't have to rely so much on policy. We can just rely on cost curves and pricing power and things like that to actually drive adoption of these new technologies. But one thing we do have to remember, of course, is to bring it back to what I was talking at right at the beginning of the presentation. There isn't just a financial cost to the net zero, not meeting our net zero targets. Climate change is having a very real world impact, which has financial consequences as well as human consequences as well. And so, although from an investor's perspective, all growth is good, from a human perspective, we do really need to be meeting that net zero scenario in order to prevent further economic damage and loss of life associated with climate change. So with that, I will hand over to Rachel, who's going to give an update on our engagement practices at WHEB.
So I'll just start with a bit of background for how the idea of the white paper came about. So stewardship and engagement have for a long time been used by investors to align investment outcomes with long-term economic, social and environmental value. The practice has become more mainstream recently, and this is primarily due to an increase in client demand, but also public policy developments. And in response, there appears to be what we have previously described as a kind of stewardship stampede, characterised basically by a lot of activity. The evidence for this is seen in a couple of things. So first of all, asset managers are claiming very high levels of activity in their stewardship reports, as seen in this chart taken from a review of asset manager stewardship reporting. It's also been reflected in a hiring spree not so long ago of dedicated stewardship professionals. The data there is a little bit out of date, but we know anecdotally that the trend continues for hiring, especially on asset owners. And it's also evidenced in the proliferation of the number of initiatives and industry associations that are looking to leverage asset manager influence to address systemic risks, some of which are shown here. Combined, all of this is contributing to a dominant narrative of more activity in the industry. However, in WHEB's view, a focus on more activity is missing the point somewhat, especially as a quick glance at the news indicates a general level of dissatisfaction with investors' engagement. What's different now, however, is that there's a raising in the level of expectation on engagement from those initiatives, and based on reports of hiring activity and also claimed activity levels from asset managers, there's an indication that it's becoming a lot more demanding on resources. So concerns about the quality of engagement may begin to raise questions about asset managers' ability to deliver client value, and also failure to address concerns could potentially give weight to some apprehensions that sustainability investing does little to change firm behaviour. In WHEB's view, at least, in order to deliver that long-term client value, we really need to think about shifting the narrative from more activity to engagement that is more effective. And the shift in narrative towards more effective engagement is essentially what the white paper aims to do. So in the next section, I'll outline the three aspects of engagement that are posing what we think are kind of significant barriers to effectiveness, as well as our recommendations for overcoming them. So focusing on consensus on the fundamentals, unlocking value against a backdrop of resource constraints, and then looking at how we can demonstrate effectiveness. The first set of recommendations from the white paper is around this need to reach a consensus on the fundamentals of engagement. But what do we mean by the fundamentals? The way we see it, these are key terms used to describe the most basic aspects of investor engagement. However, they are being used in different ways, and that's resulting in miscommunication or misunderstanding and increasing the overall risk of engagement washing. Reassuringly, in the industry, it does seem as though there is at least agreement on the purpose of investor stewardship. So most definitions tend to coalesce around this idea of creating and protecting long-term value and also economic, social and environmental benefits for savers. Whilst this provides a relatively solid foundational kind of starting point, things get a bit wobbly when we delve a little deeper into the other fundamentals. So what are they and how does WHEB define them? Starting with an objective, so what are we trying to achieve? In our view, a strong objective is one that seeks change rather than one that is focused on just information seeking. Asset managers should be able to clearly articulate what their objective is, so what they're trying to achieve, and also explain how these align with their overall investment strategy. In practical terms, we have 5 high-level objectives for our engagement work, and I'll touch on those in just a second, but we then translate these into something that is a lot more meaningful for investee companies when we engage them. So that's via a company level objective. And often that will reflect the unique kind of context or activities that that business is operating in. And then moving on to outcomes. So outcomes, we think, are basically what engagement is all about. They describe the results of the engagement. The exact definition of outcomes is somewhat debated, but they can broadly be categorized as either being at the level of the company, so where there's a change in policy or strategy or governance, which may then lead to real-world outcomes, or outcomes at the level of the investor. So, for example, a change to investment conviction regarding a stock as a result of the engagement. The final fundamental is an activity. Now, defining what counts as an activity is really important because we need to be able to distinguish between an engagement and a typical investor-investee monitoring interaction. At WHEB, we think this is best done by evidencing a clearly defined objective and outcome has been communicated to the company. I think it's worth just saying here that we definitely believe that higher quality engagement involves a two-way dialogue. But our concern is that the requirement to do this has two limitations. So first of all, it ignores the importance of investors signalling their expectations to companies. And two, it could ultimately push investors to engage only those that are most responsive, irrespective of their priority. So looking at how WHEB uses its fundamental terms in more detail, you can see our high-level engagement objectives here. Unfortunately, there's not the time for me to go through them all now, but the key point is they all focus in on the delivery of impact, which aligns with WHEB's overall strategy. I will focus in on one though, which is limiting negative impacts in the context of a case study of a former portfolio company of ours, Daikin. So for those who don't know, Daikin is a leading provider of high-quality, energy-efficient air conditioning solutions for residential, commercial, and industrial sectors. In 2023, however, it came to light that the company had been manufacturing shells that contain white phosphorus. Now, white phosphorus has two uses in battle. The first is to create a smoke screen, which is legal, and then the other is against people, which is illegal, basically because it produces really horrific chemical burns. Because of its potential to be used against people, white phosphorus is now subject to a complete ban by our ethical exclusions policy. And when we found out that the company was involved in its production, we wrote to Daikin and basically clearly outlined our position, as well as the company level objective, which is to exit the production of white phosphorus. And we also explained at the time that we would have to divest if it didn't due to our ethical exclusions. We didn't get the reassurance that we needed at the time, so we actually ended up selling our position in Daikin in Q4 last year. And that led to a couple of outcomes. So the first was that there was a change in our investment conviction. We sold our position in the company, and we spoke to peers at the time and know that we weren't the only investors to do so for this reason. The second is that earlier this month, Daikin's new CEO announced that the company will now exit the production of white phosphorus, and this is in combination with other things, but following investor pressure. So this is a company-level outcome that could lead to real-world outcomes. The third outcome is potentially in the future, so when the company's revenue from white phosphorus drops to zero, it will become investable for us. So if we were to invest again, that would be another kind of outcome. Finally, the point to make here is about defining activity around the objective. Our letter and our divestment, we think, were really clear signals of our expectations. Now, we're not claiming that it was only WHEB's actions that led to Daikin exiting the production of white phosphorus, but we think that this is a really clear example of how powerful signalling can be and why we think a response shouldn't be needed to define an engagement activity. Our second set of recommendations is about how asset managers can work to unlock value amidst the ongoing kind of discourse of resourcing pressures. We've noticed that there is definitely a sense of pressure on asset managers to demonstrate activity on an increasingly broad spectrum of issues. And this is where they need to enact a sort of balancing act. Engagement isn't ultimately an unlimited resource, so it doesn't make sense to engage every company on every topic, especially because high quality engagement requires a number of different inputs. So to be effective, asset managers really need to find a way to cut through the noise and identify what their priorities are. And in our view, we think that this begins with an integrated approach to stewardship. So by this, we mean that engagement is embedded in the investment process, and investment analysts lead on engagement with support from specialist sustainability teams. This ensures that topics are prioritised basically based on how likely it is that they will impact long-term value. But integration isn't just important for prioritization, it also helps us build a really compelling business case for engagement objectives. So by this, we mean being able to communicate objectives that recognize the wider context that the company is operating in, helps build constructive long-term relationships with company management. Our final recommendation in this area is that we ask whether industry-wide specialisation should be encouraged. I appreciate that sounds a little bit technical, so I'll just explain what we mean by that. A bottom-up approach to setting objectives for company engagement works well for active long-term managers like WHEB, especially because we have a relatively concentrated portfolio. However, we do appreciate that this probably won't work for everybody. So, for example, passive managers or asset owners who have investments spread across hundreds or thousands of companies are unlikely to be equipped to develop precise and strategic objectives at the company level for more than a handful of their portfolio companies. So instead, a more efficient approach could be to target less specific objectives, such as improved disclosure on thematic issues such as climate, gender, or biodiversity. So one example of how we have been a bit more targeted with our approach relates to an issue of antimicrobial resistance. So antimicrobial resistance occurs where deadly microbes or bacteria have evolved to become resistant to the drugs normally used to treat and kill them. It poses a really serious threat to human health and economic stability. Left unaddressed, it's expected that it could end up causing more deaths than cancer and lead to an almost 4% decrease in global GDP by 2050. Quite rightly, for this reason, it's become a really core priority for an asset owner client of ours. And we were asked the question earlier this year about how we're dealing with the topic in the WHEB strategy. Now, we could have taken this as a mandate to go and engage all of our portfolio companies on AMR, but we don't think this would work for two reasons. The first is that the nature of the strategy means that we have limited to no exposure of the primary drivers of AMR globally, which is the agricultural use or overuse of antibiotics. So this means that company engagement on antimicrobial resistance could be a lot of work, but for very little reward. The second is that even without resource constraints, engaging companies on issues that are clearly not a material priority for them is going to kind of erode our credibility with management, and therefore it has the ability to impact our effectiveness in future engagements. All of that being said, AMR poses a really significant threat to the stability of global financial markets, and we definitely recognise that this is an issue that needs investor attention more broadly. So earlier this year, we joined the Investor Action on AMR initiative. If you're not aware of it, I definitely recommend taking a look. It's a fantastic coalition between the Access to Medicine Foundation, FAIR, and the UK government. We've signed a public statement through our involvement that was presented at the United Nations General Assembly in New York a few weeks ago. And we're aware of a couple of successes from this already, including the development of an independent panel for AMR action by 2025. The third and final set of recommendations is looking at how asset managers can demonstrate effectiveness. Now, to look at effectiveness, we need to look at outcomes, but this is where things get a little bit tricky. Attributing outcomes to specific investors or claiming causation, as it's also known, is widely considered challenging and we think could put further pressure on resources. And this is because outcomes are nearly always the result of the intervention of multiple stakeholders, so not just WHEB, but other investors, company management. And in fact, it's considered so challenging that the FCA has recently abandoned its own efforts to develop an effectiveness metric based on attribution. However, without such a measure, we have been left with a bit of a drunkard search. So for those not familiar, this is a metaphor about a drunk man looking for his lost keys under the street light. And it's not because that's where he lost them, but it's because that's where the light is best, so it's the easiest place to look. In the case of engagement, the street light is activity metrics, because this is the data that is most readily available. And while this data can be useful, we don't think it paints the whole picture of what's going on. So what should we look at? In our view, investors really need to focus on collecting evidence that demonstrates a correlation between their engagement activities and reported outcomes. And then on top of this, reporting can be further strengthened where clients can draw the link between the investor's specific contribution and outcomes. And the point of this chart on the right here, this little image with our logo, is to show that it really is the group or the collective actions of a number of different stakeholders that produce these outcomes. And that's what we should be focused on trying to show. So looking at how we do this in practice, our aim really is to provide an aggregated view of engagement outcomes for priority companies on priority topics. So this chart here on the left-hand side shows how companies have progressed on climate issues between 2022 and 2023. Plotted on the chart are the top 10 emitters by financed emissions. The y-axis represents their absolute carbon emissions. A reduction of absolute emissions is basically the ultimate outcome that we're targeting with our climate engagement. The x-axis represents how aligned the company's strategies are with the Paris Agreement, which we see as being a precursor to successfully reducing the absolute emissions in the long run. Over shorter time periods, the data point should move from less to more aligned with the Paris Agreement, so from left to right. And then over longer periods, we would also hope to see the company's absolute emissions come down. This is not a complete picture itself, so we also aim to support each data point with a case study that uses a cohesive narrative to illustrate the correlation between WHEB's activity and an outcome. So basically, without trying to prove that our intervention caused the outcome, the case study should provide enough information to show how our engagement possibly contributed to the outcome. Unfortunately, there's not time to delve into this case study with T connectivity here, but hopefully you can cast your mind back a few moments ago to the description of the work that we've done with Daikin, see how our case studies work in practice. So in summary, our white paper hopes to explore some of the obstacles that we've discussed today, which are obstacles to effective engagement. And in doing so, we've also tried to propose some recommendations for where we think asset managers and the industry more widely should focus improvements. And these are developing a consensus on the fundamentals, looking at strategic prioritization to deliver more client value, and also demonstrating effectiveness by evidencing contributions rather than seeking to claim causation. Thank you very much, and looking forward to any questions, feedback, or comments.
Great, thank you, Rachel. Thank you for that. And just to end with a bit of a plug there, as I said at the very beginning, we are publishing a white paper on this topic in terms of around stewardship and our positioning and our view of what's happening in the stewardship market, which we're publishing next week, and we're launching that together with a webinar together with Pensions for Purpose, which is next Tuesday on the 29th at 9:30 a.m. And there is the registration link if you'd like to dial in for that as well. So thank you, Rachel, for giving us those highlights there. And at that point, we should be able to move on to questions. So I'll ask Rachel if you come back onto the screen. You are, and Claire as well. We'll stop sharing there and we'll move on to your questions. So please use the Q&A function to ask any questions you like. And Claire, if you're back with us, Rachel, if you just stop sharing the screen there. I'm going to start off just with one for Claire on what is our view on the AI investment conundrum, a catalyst for positively impactful solutions versus or is it an emissions accelerator which will ultimately create more harm than it can do good? And has WHEB positioning the portfolio in the light of our stance there?
Yeah, it's a great question. And I think the short answer is that we don't see AI as a positively impactful solution in and of itself. And in fact, when you consider kind of, as you say, the massive energy associated with AI and data centers and energy, used by all of those different things, it is largely a negative impact, probably more than it is positive. So although we do have companies in our portfolio that have utilized AI in different ways to improve their core business, be it, coming up with new healthcare therapies or helping buildings to be more energy efficient, AI can certainly help them do those core business activities in a way that is a bit better. Fundamentally, on balance, AI is probably doing more harm than good. We don't invest directly in companies purely on the basis of AI. We do have some second derivative exposure actually through our cleaner energy companies because these data centers and stuff use so much energy, there is an associated growth opportunity for the companies that can provide their energy capacity. And so that's actually our closest second derivative exposure to AI. And we have also looked at companies that could potentially help to negate the negative impact of AI. So we've been looking at companies that can cool data centers, for example, although we haven't yet been able to find one that is really appropriate as a portfolio investment. It's something we've certainly been looking at. But no, I mean, when you think about those companies that are most well known for AI, those aren't going to be found in our portfolio because we don't see it as a positive impact in and of itself.
Great, thank you, Claire, for that. So turning to you, Rachel, is there a link between this is unusually for us has been the first first presentation we've done for quite a while where we haven't talked about SDR or the FCA's sustainability disclosure regulations. But I was going to ask, well, there's a question that's come through about the link between the Stewardship White Paper and the sustainability impact label, which you'll have seen proudly displayed at the beginning of this presentation. Have we needed to make any changes to our stewardship approach because of the FCA label and the new prospectus that we launched just over a month ago?
Yeah, so I think it's just worth being really clear that we haven't made any changes to our approach to stewardship and engagement as a result of being awarded the label. But obviously our work to secure the label and also on the white paper was happening at the same time over the summer. And as part of both of those processes, I think one thing that we have now done and is evident in the prospectus is that while we've always been really clear about having well-defined objectives for our engagement at the company level, we now have a set of those 5 high-level engagements at the level of WHEB. So thinking about what are we trying to achieve through this work. And I think that is really beneficial and will be really beneficial for us being really clear about that going forward so that we can think about prioritization and also where we're kind of allocating resources, and also in terms of thinking about how we can be even clearer to our clients about the investment activities that we're undertaking as well. So I only see that as being beneficial, but as I say, no real changes to the overall approach to stewardship and engagement as a result.
Great, thanks, Rachel. Claire, we did have a question at the beginning. Obviously, this presentation today and today's webinar is very focused on the third quarter, but we're very conscious that the last couple of years and even 3 years has been a tough period for performance relative to the sort of regular mainstream benchmarks. And so we had a couple of questions just in terms of the gap between that, the explanation for that. Do you want to just give a couple of comments on that, and I'll follow on?
Yeah, of course. So it is a question that we get a lot. And the reason is that actually comparing our strategy's performance to indexes or peers can be quite challenging because of the way in which we and other peers in particular define impact investing and define sustainability investing. So when we look at our portfolio relative to the index, the MSCI World Index that we use for a performance comparison, we only have, like, our universe, our investable universe, only has a 15% overlap with the MSCI World. So that's 85% of that index, which we can't access, we can't invest in, because it doesn't meet our impact threshold, which basically is that over 50% of their revenue or profit has to be aligned with one of our sustainable impact themes. And so recently, and I say recently as in the last few years, our performance relative to the index has actually been more driven by the things we don't own than the things we do. If you look at our performance relative to the universe, we're kind of flat to positive. But when you look at our universe relative to the index, we are negative because the index has been driven by things we don't own, particularly the big tech stocks like Nvidia, Meta, Apple, and at various shorter time periods as well, things like financials and oil have also been benefiting the index and not been benefiting us, of course. So that's really, I guess, the kind of danger I would suggest when you're comparing our performance relative to not just our index, but peers as well, is that different impact funds, different sustainability funds will define their opportunity set in different ways. And many funds that market themselves as sustainability or even sustainable impact will hold companies that we would consider uninvestable because of that rule around having revenue which is aligned to one of our sustainable themes. So yeah, that's just something to be mindful of when you are, I guess, shopping around for different sustainability funds.
Great, thanks, Claire. And one of the things that has kind of, I think, been a big feature of the period when that's been particularly challenging has been it's been associated with a period of higher interest rates and higher inflation. We've obviously, we're feeling more confident that that is now clearly sort of changed direction from this point, and so hopefully that will benefit that comparison as well as we go forward from here. When do we expect, now we're seeing clearly a trend downwards in interest rates. When do we expect to see our portfolio companies start to see the benefit in their underlying trading from lower interest rates, Claire?
Yeah, so when is a very difficult question. I mean, certainly we are seeing interest rates begin to decline. Predominantly it's North American, so US interest rates, which are most important for our companies because they tend to have a very big revenue exposure to the US. And so, interest rates do impact customers' purchasing decisions in different ways in different sectors. Cleaner energy in particular has been impacted in some spaces, particularly in wind and residential commercial kind of rooftop solar. That's been impacted by higher interest rates because of the kind of cost of capital required to actually build a new wind farm or solar panel farm has increased with the higher interest rate. And so as interest rates come down, the kind of cost of capital to make those investments will also come down, and we should see a resurgence of demand for those technologies. Obviously, some sectors have been also kind of similarly affected by higher interest rates. Any industrial sector is impacted by kind of similar issues. People have been less inclined to build new factories because of the cost of capital requirement. A lot of customers in the more consumer-focused space have been delaying investments in things like warehouses because they have invested quite a lot during COVID, and now the cost of capital is higher. They're kind of thinking, oh, we'll try and make do with what we have before making any big investment decisions. And so having a lower interest rate, lowering that cost of capital, will encourage companies and cleaner energy developers and all sorts of different businesses to continue investing kind of similarly to how they were before the interest rate hike. The question of when is more difficult. Certainly, I would hope within the next kind of 12 months, we should start to see some positive signs. But, calling when exactly the lower interest rate will kind of feed through into better fundamentals is something that is quite difficult to do, and I'm not going to attempt it now.
Yeah. Good. Okay, thanks, Claire. Switching back to you, Rachel. Do you and colleagues have views on the direction of travel in the FRC's Stewardship Code review and the calls from parts of the industry to streamline reporting? Do we agree with that, and how valuable is the Stewardship Code's signatory status to WHEB?
Thanks. Yeah, I think just starting off with the value of signatory status to WHEB, I think it is, obviously being able to say that we're a signatory to the code is something that is important. It shows that we've achieved a certain level of quality with our approach and our reporting. That being said, the overall, I suppose, impact of the Stewardship Code on stewardship and engagement more broadly is limited somewhat by the reporting burden that it adds for asset managers. And we still get a lot of questions from clients for information that's in our stewardship report. So I think that just shows something about the usefulness of the reporting in its current form. So I think we definitely support any improvements to the code, and I think the direction of travel should definitely look at what we're trying to achieve through the white paper. So focusing away from just more activity for the sake of more activity, and instead thinking about how we can improve the overall quality of the work that's being done through some of the recommendation that WHEB has mentioned. And focusing on work that is more effective, I think would be really beneficial. So yeah, I think we're generally supportive of the review of the Stewardship Code, and we're hoping to share some of our recommendations with the FRC as well.
Thanks, Rachel. Well, we're just coming up on the hour, so we're going to draw it to a close now. But thank you, everybody, very much for joining us this morning for this Q3 webinar. As I mentioned at the beginning, we will be doing a longer-term overview of performance and the strategy and the outlook for the strategy when we get to our annual investor conference. That's on the 28th of November in the morning in central London. So if you look on our website, there's a registration form link for that there. So please do sign up and we look forward to seeing you there. And I'll also give one last plug for Rachel and Seb's webinar next week, which is the sort of longer form launch of the Stewardship White Paper next Tuesday on the link that I sent you earlier, and we'll send out on our newsletter in the next couple of days to make sure everyone's got that link as well. So thank you everyone for joining this morning. Thank you, Claire. Thank you, Rachel, for your contributions, and we'll look forward to seeing you next time. Thank you.